All right, this is the third separate tutorial I have posted covering how to prepare schedules K2 and K3 with a Form 1065 filing. So this is tutorial 3 that's going to address what the K2 and K3s look like when we have an investment partnership. So this is a partnership entity that's just trading stocks and bonds and other financial products for its owners. It's not actually conducting any active trader business. In playlists 1 and 2, these are more akin to actual operating businesses. So in the first one here, U.S. LLC, this is a Form 1065 filing where there's no effectively connected income and you have foreign ownership. So we see how all of that non-ECI income, the foreign branch category income is flowing through to the partners. So there's really no U.S. withholding tax issues. In the second one, we do have some ECI. So we have an LLC partnership that has a foreign branch and it has a U.S. branch where it does earn some ECI that's subject to withholding when allocated to the foreign owners. And then there's also a piece that has non-effectively connected income. So if you haven't seen these two first, I would recommend watching those first before this one. And then you can come back to this one and get some more concepts on portfolio income and how it flows through in an investment partnership context. So first video here, I want to go over the background on this fact pattern, and then in the subsequent videos we'll actually look at the 1065 itself, the relevant forms. So we'll go through Form 8949, Schedule D, Schedule K1s, and we do have 1042 filings because we have U.S. source dividend income that's subject to withholding, and we have to file those. And then we'll look at the K2 in more detail, and then ultimately K3 and the Schedule K1 for some of the non-resident partners. So what I've got in front of us, similar to the other videos, I got a slide deck, and we also have a set of financial statements here. So this is the cap roll. Let me start with the financial statements. So we got the profit and loss and balance sheet for the fund. So this is what the balance sheet looks like at year end, the different types of income and expense, and then the cap roll forward. So the cap table is really important in investment fund context because you need to be very precise about how you're allocating all the different types of income that's running through there, the expenses, distributions. And so I've got one of those set up here for our fund, and we'll go over that as well. And then lastly, of course, the return. So the 1065 full return with the K1s, K2, K3. All right, so if we go back to the slide deck here, cover some of the background here so we could set up, the return being prepared and what's going on within this entity. So what we've done here is we have a fake investment fund, LP. So this is a limited partnership formed in Delaware during 2021, and it has 4 partners. Now, the purpose of the fund from the beginning was the intent to invest in publicly traded stocks on exchanges in the U.S. and in Switzerland, right? So we set up an LP in the U.S., we opened brokerage accounts in Switzerland and in the United States. So we're trading U.S. publicly traded instruments and Swiss publicly traded instruments. Now, the partner cap schedule looks something like this, and the reason why these elements here, partner type and residency, are relevant is because it impacts the tax attributes of the fund, right? So John, he's a U.S. citizen, U.S. tax resident. He put in $500,000. Jane, also a U.S. citizen individual. She put in $500,000 in cash. And then this is where we have the non-resident partners that make it a little trickier, right? This is why the K2 and K3 are so important. So we have this individual, Ben Church. He is a German citizen and German resident. So these guys all, let's say they're all friends and they decided to form this investment entity together. So he's in Germany. He put in $750,000. And then the last partner here is another limited partnership, but a foreign one. So we have a foreign LP. It's a Cayman limited partnership, Cayman Islands feeder LP. And this entity contributes $1.5 million. Now, this is a foreign limited partnership. We don't know who the partners are underneath there. In other words, all we know is this is the investor. We don't know whether there's 2 investors in this LP or there's a 2,000, what the makeup is. And so that's also why it's really important to complete the K2 and K3 as accurately as possible, because depending on who the owners are of this LP, there could be a lot of information flowing through to them that's necessary. Okay, so none of the securities purchased by these funds are going to be PFICs or CFCs. That's really important because if it is a PFIC investment or a CFC, we have to do additional forms and schedules, right? And so for this tutorial, I'm trying to keep it relatively straightforward. So I'm leaving it to simply publicly traded U.S. and foreign securities. The foreign securities do not meet the definition of PFIC, so we don't have any mutual funds or anything like that. And it's not a CFC in that, we're not acquiring a large enough position or there's other closely held owners where we have that become a problem. Okay, so additional information on the fact pattern here. The fund prepared the financial statements and cap roll forward. I showed you those earlier. Now, the financial statements, really important here that we have sufficient detail to show the different types of income and the source, right? And that's important because we need to bifurcate a lot of this on the K2 and K3. So if we don't have that detail in the financial statements, then we can't do that. Now, if we look at the financial statements just really quickly so you can see what it is I mean exactly. Notice here how on the investment side, we're showing interest income from U.S. sources, interest income from Swiss, dividend income from U.S. So in other words, I don't have just one line item that says interest income and there's a total. I'm separating them by source because this information is going to be necessary when I prepare the K2 and K3. Okay, so some background on sourcing, right? Just some of the basics here that we need to familiarize ourselves with. Sourcing of income is very important, right? And that's the whole purpose of the K2 is we as the partnership have to source certain items and then we categorize other items that are sourced at the partner level. But some of the ones that we're going to be dealing with here are the common ones, right? So dividend income, sourced to the payer's country of incorporation. Right, so if you can find these rules in Section 861. Basically, if it's a Delaware corporation paying dividend, it's U.S. source income. If this is a dividend coming from a French corporation, it's going to be French source dividend income, so that'll be foreign source dividends, right? So to keep that in mind when we look at the Swiss dividend distributions. Similar concept with interest, right? So the residence of the payor, so the entity or the person or the fund that's paying the interest to us. The source is based on the residence of the paying person. Okay. Now, capital gains and losses, this is where it gets a little tricky sometimes. So generally, the sale of capital gains and losses on the sale of stocks, which are treated as personal property, are sourced to the seller's tax home, right, under 865A. So when we have a partnership, like we do now, when the partnership is the legal entity that's selling the property, so it's selling those stocks, selling those bonds, the source is not determined by the partnership. It's determined at the partner level. So we find that in 865I5. So what that means is that when we separately categorize those capital gains and losses, the source is going to be determined by each limited partner that gets this income, right? So we don't decide whether it's U.S. or foreign source. Now, there is a caveat to that, right? If there's a sufficient amount of tax imposed on the capital gain at the foreign country level, then we can source it to that country, right? We can make that determination at the partnership level. Now, what else happened within the fund? The fund distributed 10% of its net income allocated each partner as a dividend or a draw, really, right? So a partner distribution. So we'll take a closer look at that on the cap roll forward here. We do have a section saved out for distributions, right, to the partners. Switzerland. So Switzerland does impose some withholding taxes on the dividends. So the dividend distributions were subject to tax, and the tax is being allocated proportionally to each partner, right? So based on their allocation of the Swiss dividends. All right. Okay, so some additional tax issues to consider here. We did receive both U.S. and foreign source dividends, right? So the foreign source dividends were subject to that 15% withholding tax. We'll show how to account for that, pass that foreign tax credit on. The U.S. source dividends paid into the fund So with our U.S. brokerage account, those are not subject to withholding tax before it gets into the fund. And that's because it's being paid into a U.S. LP. It's our job as the U.S. limited partnership to withhold any tax if necessary on the dividends allocated to those non-resident partners. So, for example, when we look at the cap table here, the amount of USA sourced dividends, right, in this column being allocated to each person, the dividends being allocated to U.S. residents aren't subject to any withholding tax, but to the extent we have U.S. sourced dividends allocated to non-residents, such as Ben Church here or the Cayman Islands feeder, we do have some withholding tax that applies, right? Now, the base rate is 30%, but it can be reduced by treaty. So Ben, being a German resident, he's claiming the reduced treaty rate. Okay, so that's why he has a lower dividend rate. So now the interest income, again, we got both U.S. and foreign source interests here. None of the Swiss interest income is subject to withholding taxes, so Switzerland lets us take that free and clear. The U.S. source interest qualifies for the portfolio interest exemption, so we have U.S. source interest income allocated to non-residents, but it's not subject to withholding tax under 871H1. So not all U.S. source FDAP income is subject to withholding taxes. The dividends might be, but the interest isn't in this case. The capital gains, going back to the personal property sourcing issues, right? We're going to have the sale of both U.S. and Swiss stocks. Neither of these capital gains in either country are subject to taxes in that country. And the source, again, is going to be determined by the residency of each partner. And so I'll show you on K-2 and K-3 where we make that, basically what column we add that to make it clear to the partners that the sourcing has to be done on their side, right? We don't make that determination at the partnership level. And then lastly here are the investment expenses. So if we look at the financial statements here, we can see on the expenses side, not much, right? That's the withholding taxes. That was coming off the top of the Swiss dividend income. And then we have investment management fees. So the fund did hire a third-party investment manager to manage the portfolio, and that's the total amount of fees that they charged us during the year. Now, for purposes of this example, we're going to assume that the fund does not qualify as a trader for federal tax purposes. This is always something you need to look at carefully. Are you an investment fund or a trader fund? The investment funds, these types of investment expenses are generally not deductible, right? So they were formerly deductible as an itemized deduction subject to a 2% AGI floor. But now, following tax reform, they're generally not deductible at all. The reason we still account for them and report them on the K-1s is because not everybody follows the federal tax treatment. Some states still allow you to deduct these expenses. And other foreign jurisdictions might allow it too. So, we have, Ben Church here being allocated income. Maybe in Germany, he's allowed to deduct those 2% fees. So we don't want to completely ignore them. We want to still report them. And then in the hands of Ben or this Cayman feeder, whenever it flows through to their owners, maybe they can do something with it. Okay. Now, the expenses are being allocated across all of these dividends, foreign dividends, and capital gains income, not allocating anything to the interest because it's just like bank interest. So to the extent that the interest income is earned within the managed portfolio, we'll allocate it to that. But if it's just sitting in a bank account and not doing anything, it doesn't make sense to allocate the investment management fees to that. All right, so last slide here, I want to talk about the parts we're completing. So we'll be doing parts 1, 2, 3, and 10. The parts 2 and 3 have to deal with foreign tax credit information, so sourcing U.S. to foreign, and then the foreign taxes paid. This is the dividend withholding on the Swiss stock. So we want to be clear that we have a 15% withholding tax being imposed on just the Swiss dividend income, and that's going to be clear when we look at part 2 and part 3. Part 10 covers ECI versus non-ECI, so that will break out the different types of portfolio income, whether they're effectively connected with a U.S. trade or business or not, and then whether they're U.S. FDAP or not. So we'll look at those in more detail. and then the parts that are not being completed here. So these are not these are the parts that we don't need for a variety of reasons, right? So for example, Part 6, Subpart F and guilty inclusions, we don't have any CFCs, right? Remember, we don't have any PFICs in Part 7. We don't have any CFCs, so Subpart F or guilty is a non-issue. We don't have an FDAP, not a covered partnership because we don't have any dividend equivalent payments or any kind of unique financial products that we're issuing. And then Schedule K-3, Part 13, this won't be included with the K-3s because we don't have any partners that sold their units or redeemed out, nor do we have any Section 751 hot assets, right? So hot assets are things like inventory, unrealized receivables. In certain cases, when partners sell their units or redeem out, they might have a deemed sale of those assets and an ordinary income inclusion. Not the case here. All right, so this covers the intro for the first video. Now let's start jumping on to the second video where we'll revisit the fact pattern a bit and then look at how all the numbers end up on the 1065, pages 1 through 5, and the relevant 8949, Schedule D, and then we'll touch on the 1042s as well. All right.